Welcome to Roaming Returns, a podcast about generating a passive income with dividend stocks so you can secure your finances and liberate your life. Today, we're tackling a big debate in the investing world. Can you actually make money with YieldMax ETFs? So many people think the answer is a hard no, but the data says, well, you'll have to stick around and find out. We're diving deep into 6 YieldMax funds that have long and short pairs. People say these are a trap, but we ran the numbers, tested the strategies, and we've got hard evidence that might just change your mind. Does holding both the long and short positions protect your principal? Is reinvesting dividends a mistake? What's the best way to actually profit from YieldMax ETFs? If you're serious about using high-yield ETFs to generate cash flow without getting wrecked, this episode is totally for you. Let's dig into it. So as we promised, this week...
What's up, y'all?
We are back with some awesome more YieldMax.
It's going to be a YieldMax thing that I was on Reddit. I visit Reddit not to participate in conversations because, you know...
He doesn't do that.
People are whatever they are. But I read the conversations, and it's one of the interesting... not a consensus, but a majority of people think that you can't actually make money in YieldMax. So anytime people bring up a thread about YieldMax, they're like, "Oh, you're stupid. Why are you invest in something where you just lose money? You're stupid. You're stupid. You're stupid." So one of the ones that caught my eyes though was like they were talking about doing like remember I had said that we were doing the Tesla long and the Tesla short, the TSLY and the CRSH. Someone brought that up and said it doesn't matter, and I said, "Oh, I know that's not true." And so like once I got in my head that I was right, I went...
Wait, what did they say didn't matter? If you did the long side and the short side?
If you held both, it didn't matter. You still lost money. And that's not true. So
all right. That's
what this is all going to be, is how if you buy both, the long and the short, and the 3 different things that... and there might be 4 now, but the 3 main ones are NVDY and DIPS. NVDY is NVIDIA long.
You mean pairings?
Yeah, DIPS is your short on NVIDIA. The second one is CONY. And FIAT, CONY long. FIAT is the short of the CONY.
FIAT.
And then the third one is the TSLY and the CRSH that we have mentioned time and time before. So I just did some back data on these just to prove my point, because why not?
Because Tim likes data.
The discussion that I was looking at was about buying both to mitigate loss. The people said you can't make money. And I said, well, I know that's not true. And I actually have the data now to prove to you that it's not true. You can make money even. You have to remember, like, we had a serious downturn since January. So you're going to be down, and you're going to be down pretty much in everything. So like the data is kind of skewed in that regard, so I probably should revisit this in a sideways market or a slight bull market just to prove my point again. But
so even in the down market. But
if you buy YieldMax, any of them, and you turn the drip on, probability is you're going to lose money. Mm-hmm. We've discussed that time and time again. But now I actually have data that shows you this, and so we're going to go through here and look at it. Like basically what I did is I looked at the last 6-month dividends up for all 6 of them: NVDY, dips. And then I CONY, FIAT, and Tesla crash. And then I looked at the share price the day after the dividend. So like if you get your dividend and you reinvest it, they have the share price will be the day after the dividend's paid out. So then you'd be buying back at that price. And then I just went through and I calculated everything to come up with data for you guys. It's actually interesting. I think it's interesting, but I'm a nerd, so I don't know. I'm eating the spaceship cock.
The cockpit. Yes.
Okay. So the last 6 dividends for NVDY were on 10/10. It was $1.10. We're going to pull it up so you guys can read it. So I'm not like, so we all can see it together. Ooh. 10/10, it was $1.10, 11.7, 102, 12.5, 119, 13, 90, 130, 83, and 227 was $1.61. You go to the next column over there, you'll see that the last 6 dividends of dips, which again is the short of NVIDIA, was 10/10, 69, 11.7 was 61, 12.5, 64, 1.3 was 51, and 130 was 50, and 227 was 58. So then you look at the share price.
Those were the months and the
that was the dividend. Yeah,
month.
So that was the dividend. So here is the share price the day the dividend was paid. 10.11 was 24.70, 11.8 25.98.
So wait, what is this based on? Like how many shares? Did I miss that whole part?
No, we'll get to that.
Oh,
this is just the upfront data. 11.8 was 225.98. 12.6 was 24.76.
I'm sorry, you guys.
1.6 was 24.02. 131 was 19.31, and 228 was 17.21.
So big drop.
Huge drop. Dips price was $15.32 on 10.11. 11.8 was $13.15. 12.6 was $12.70. 1.6 $11.82. 131 $12.62 and 228 $12.26. Now what I can see from that right now, just looking at it, is the share price from NVIDIA went down a shit ton and the share price from Dips didn't. And like when NVIDIA really started to decline here on 131, there should have been a bigger jump from 11.82 to 12.26. So that's crazy right there.
That is a big jump. 24 to 19 versus 11 to 12 actually went up.
Yeah. So like for this last 6 months, you would have collected $6.65 in the NVDY dividends, and you would have collected $3.53 in DIPS divvies collected.
Per share.
The price from NVIDIA declined from 10.11 through 12.28 at 7.49, and the Dips price declined 3.06. So if you invested $1,000 into NVDY in October, you would have got 40 shares. It was $25 a share on 10.7. Dips would have got you 59 shares, $17 a share on 10.7. So using the math, here we go.
So you're investing $1,000 and $1,000 equally on both sides,
yes.
Right? That's what I'm interpreting?
Yes.
All right.
So we're doing equal money.
So here's what the maths puts out.
Here's the maths. 10.10, you would have collected 44, and you would have actually dripped back in $1.78 shares. 11.7, you would have collected 42.62, and you would have dripped back in 1.64 shares. This is in the NVDY. 12.5, you would have collected 51.67, and you would have dripped back 2.09. 1.3, you would have collected 40.96, and you would have dripped back 1.71. 1.30, you would have collected $39.19, and you would have reinvested 2.03 shares. On 227, you would have collected $79.29, and you would have reinvested 4.61 shares. So as of 3/11, when I did the data for all this, which was not too long ago, your total NVDY shares would have been worth 15.82 at the time when I looked it up, and all your shares combined would be at 53.86. So you'd have collected 13.86 shares, would have given you 852.07. Now, if you had just collected NVDY in cash, your 40 shares, remember this is going to be 40 for all 6 now. Yep. You're not going to be reinvesting. So you would have had 40 shares. You would have got 44 on 10.10.
This is the dividend payouts, $44.
$40.80 on 11.7, $47.60 on 12.5, $36 on 1.3, $33.20 on 1.30, and $64.40 on 2.27, which would have given you $266 in cash. Your 40 shares would have been worth $632.80. So you add the 266 plus the 632, you get a total of $898.80. So you actually would have made, $36 more had you just collected cash with your 40 shares as opposed to selling your 53.86 shares. So you're up, which proved my theory, for one.
In a really, really big decline. Check that out.
I mean, you're still down. If you look at it, you're either down, like on 852, you would have been down $148 total, and with the dividend reinvestment, and you would have been down $101 had you just collected cash.
Mm-hmm. But you're still up more.
You have to remember that's $1,000 starting price, but you're up more by collecting cash. So if we do the same math for DIPS, 10.10, you would have collected $40.71, and you would have reinvested 2.66 shares. 11.7, you would have collected $42.53, and you would have reinvested 3.24 shares. 12.5, you would have collected $41.54, and you would have reinvested 3.27 shares. 1.3 would have been $34.77, and you would have reinvested 2.94 shares. You're getting a lot more shares, 2.94. Mm-hmm. 1.30, you would have collected $35.56, and you would have reinvested 2.82 shares. And on 2.27, you would have collected $42.88, and you would have reinvested 3.50 shares. So if you went and you sold this on 3/11 when I did the prices, same date as the NVDY, you would have had your total DIPS shares would have been worth, at the time it was $13.29, and you would have had 77.43 shares. So you got a shit ton more shares.
Yeah.
Would have given you $1,029.04. However, if you collected cash only on your DIPS, your 59 shares would have got you $40.71 on 10.10, $35.99 on 11.7, $37.76 on 12.5, $30.09 on 1.3, $29.50 on 1.30, and $34.22 on 2.27, which would have given you a total amount of cash collected of $208.27. your 59 shares would have been worth 784.11. So if you add the 208.27 plus the 784, it would have given you a total of 992.38. So here you would have lost $30
From your baseline? From the difference.
So you would have made $30 had you reinvested your dips, but you would have lost $8 had you just collected cash. So if you do your NVDY with the drip reinvestment plus your DIPS with the drip reinvestment, you would have actually had $1,881.11. So you lost $119+ on that.
Yeah.
And if you would have done it without the drips for NVDY and DIPS, you would have $1,891.18. So you would have lost $109.
And that's the $2,000 starting price. So that's not too bad at all compared to what we lost in CONY by itself.
So just for comparison, I just took the NVDY stock from 10.11 through 3.11.
You mean NVIDIA, NVDA?
NVDA. It was up 1.13. So you actually would have had you had $1,000 and you would have had 1,001. So you actually would have
paid better in NVIDIA.
Just if you just invested in NVIDIA, yeah.
For the snapshot time frame.
But this is 6 months, and I'll probably revisit this and do like a full 12-month thing just to see if it holds up. Mm-hmm. But so far, for the pair, remember, if you do the pair, you want the whole idea behind the theory is if you hold the long and the short, that you're going to lose less capital appreciation, which you did on both instances. So it would have been 1881 as opposed to 1891. So you still would have lost a little bit of money, but you wouldn't have lost if you held NVDY by itself, you would have lost more. And if you held dips by itself, you would have gained a little bit more. So this one here, it actually benefits you more to hold the short side because NVIDIA did have an awful 6 weeks. But still, I like the fact you're only losing $100 and not $8 if you just...
Yeah, because what you would do is you just double those shares, right? And you'd put them back in here, so doubling the loss.
So if you just sunk it all into one, you would have lost... If you just sunk it all into NVDY, you would have lost $203. If you sunk it all into just dips, you would have lost more than that. So you would have lost...
you would have lost less with dips by itself.
Yeah, dips by itself, you would have lost less.
I was going to say, that price drop that we saw before wasn't whatever. So, yeah, totally a thing.
So... Again, but a way to not lose money. You have to remember, I know. I
feel like this isn't going to be the drastic one compared to the next one.
I know you're losing money, but at the same time, the markets were down. They've been down 10 to 12%. So losing $108 is all right.
No big deal.
Okay, so that's that one. Now we're going to do the CONY one.
Yeah. And if you have been paying attention to our CONY experiment.
A disaster.
It has literally been nothing but gone straight down. And if you haven't, $17.12 is what we bought in at, $15,000 worth. And yeah.
So the last 6 dividends for CONY were on 10/17, $1.11. 11/14 was $2.02. 12/12 was $1.34. 1/8 was 83 cents. 2/6 was $1.05, and 3/6 was 60 cents.
Pitiful 60 cents.
And on the other side of that, the fiat one on 10/17 was $1.45. On 11/14 it was 73. On 12/12 it was 68. On 1/8 it was 65. On 2/6 it was 55, and on 3/6 it was 68. So again, that one is better, I think, Oh,
so these numbers aren't going to be as bad as our numbers, and I'll explain here why.
So the CONY price on 10/18 was $13.81. On 11/15 it was $18.39. Right after the election, everything went up. On 12/13 it was $15.86. On 1/9 it was at $12.44. On 2/7 it was at $12.04, and on 3/7 it was at $9.39. So it went down a lot. It went down $4.42.
Remember, I said we bought at $17.12, so we bought beginning of December, I believe.
We bought December.
Yeah, beginning of December, and it was a lot.
And then the fiat price went from $15.50 on 10/18 to $9.17 on 11/15, $7.77 on 12/13, $8.46 on 1/9, $7.41 on 2/7, and $8.01 on 3/7. So fiat.
So this one went down a lot too.
So fiat declined a lot. It went down.
Whereas the last one, it actually went up, didn't it? The short side went up in the last one?
The short side wasn't as down as much as this one. The short's up way, way, way more than the long.
You mean down more?
Yeah, it's down. That's a huge
yeah,
remember
disparity.
NVDY was at $7, and dips was at 4 something.
Okay, so this is the reverse of that.
So CONY, you would have collected $6.95 in dividends the last 6 months, and you would have collected $4.74 in dividends in fiat the last 6 months. So if you invested $1,000 in CONY in October, you would have got 76 shares at $13 a share. And if you invested $1,000 in fiat in October, you would have got 49 shares at $20.50. So CONY, you would have collected $84.36 on 10/18, and you would have reinvested 6.11 shares. On 11/15, you would have collected $165.86 with a 9.02 shares reinvested. 12/13, you would have collected $122.11 with 7.7 shares reinvested. 1/9, you would have collected $82.03 with 6.59 shares reinvested. 2/7, you would have collected $110.69 with 9.19 shares reinvested. And on 3/7, you would have collected $68.77 with 7.32 shares reinvested. So on 3/11 again, you would have had 121.93 shares. So you got a lot of shares. You went from 76 up to 122 shares about there. But your value would have been worth $8.24 at the time. Your shares would have been worth $1,004.70. If you collected cash, though, you would have received $87.69 in October, $153.52 in November, $101.84 in December, $63.08 the 1st of January. I think it was the 3rd of January, something like that. $79.80 at the end of January, and $45.60 at the end of February, which would have gave you a total amount of cash of $531.53. Your 76 shares would have been worth $626.24. Remember, you're taking 76 times 8.24. And then you add the 626.24 plus the 531.53, you get $1,157.77. So you would have made $153 more just collecting cash and not reinvesting on CONY.
Man, I wish that would have happened for us.
That's a huge difference.
I wish that would have happened for us. We started way too late.
Yeah. And so if we do the numbers for fiat, here we go. Fiat on 10/18, you would have collected $71.05, and you would have reinvested 4.58 shares. 11/15, you would have collected $39.11. You would have reinvested 4.27 shares. On 12/13, you would have collected $39.34 with 5.06 shares reinvested. On 1/9, you would have collected $40.89 with 4.83 shares reinvested. On 2/7, you would have collected $37.26 and you would have reinvested 5.03 shares. And on 3/7, you would have collected $49.48 with 6.18 shares reinvested. So as of 3/11, your total number of shares in your fiat would have been 78.95. So not near as many accumulated shares with the drip. And the price was $8.59 on 3/11. So you would have had $678.18 only with your drip on. That's what you would have collected.
Ooh, that's low.
So had you taken cash, you would have received $71.05 in October, $35.77 in November, $33.32 in October or December. I can think.
You went backwards.
$31.85 in January, $26.95 in February, and $33.32 in March which would have given you a total of $232.26. Your 49 shares would have been worth $420.91, making your total $653.17. So you would have lost a little bit in fiat just collecting cash, but it's only like $20. But if you did these together, which is the whole premise of my theory, CONY with the drip plus fiat with the drips reinvested, you would have had $1682.88 total with $1,000 in each. And if you did it without the drip and just collected cash, you would have had $1,810.94. So
you'd only be $200 down.
You would have made a lot more without reinvesting as opposed to reinvesting. At Coinbase, the last 6 months, the price when I looked this up was up around 12%, which it's not accurate anymore. But
really, 12%? How is that possible with that decline? That's crazy.
So you made $128.
And you just say, I don't know.
I don't know. You made $128.06 by taking cash. So you made quite a bit more in this
scenario.
In this scenario, yes. And the last two are the ones that we actually hold. So we have TSLY and CRSH.
TSLY was that one that like crash burn did a reverse stock split. So these should be.
These, I don't know.
This is going to be interesting.
I don't like these two, actually. I don't know why. I just took them because they were both really kind of cheap, so I could just get $500 in each.
I was going to ask you why you actually picked these two as the two to get in for this experiment. So it's just because they were on the cheap side?
Yeah. Tesla's last 6 dividends were 10.3, it was $1.09. 10.31, it was 60 cents. 11.29, it was $1.22. 12.27, it was $1.27. 1.23, it was 72 cents. And 2.20, it was 58 cents. And Crash had, on 10.3, it had 98-cent dividend. 10.31 had a 45-cent dividend. 11.29 had a 38-cent dividend. 12.27 it had a 37-cent dividend. 1.23 had a 29-cent dividend, and on 2.20 had a 38-cent dividend. So just looking at the number, I actually like how the numbers in Crash look, but that's
neither here nor there.
Yeah. So the TSLY price on 10.4 was $12.72. On 11.1 it was $12.01. On 12.1 it was $14.66. On 12.28 it was $14.73. On 124, it was $13.55, and on 221, it was $11.03. And I can tell you,
damn, that held up pretty hard.
It's lower than that now, and then the Crash price on 10.4 was $12.16. 11.1, it was $11.11. 12.1, it was $7.64. You see, that's a massive drop there. Mm-hmm. That went down to like $3.50. Wow. 12.28 was at $5.90. 124 it was at $5.78, and 221 it was at $6.12. So the total price decline in Tesla during the last 6 months was TSLY. Was $1.69 decline, and the total decline in Crash in the last 6 months was $6.38. So that's a big difference. It's a huge difference here compared to the other two. Total TSLY dividends you collected was $5.48. And the total CRSH dividends you collected was $2.85. So if you do the same math, $1,000 invested in TSLY in October would have got you 74 shares at $13.50 a share. And $1,000 invested in CRSH would have got you 77 shares at $13 a share. So using the data, we have TSLY, you would have actually collected $80.66 on 10.3, which would have got you 6.34 shares reinvested. On 10.31, you would have had $48.20 collected in dividends, and that would have reinvested 4.01 shares. On 11.29, you would have collected $102.91 with 7.02 shares reinvested. On 12.27, you would have collected $116.04 with 7.88 shares reinvested. On 123, you would have got $71.46 with 4.85 shares reinvested. And on 220, you would have got $60.38 collected with 4.46 shares reinvested. So if you sold all of your shares on 311, you would have had 108.53 shares, which would be worth $855.22 on 311. The price of TSLY was $7.88 a share.
Oh, Lilith.
If you collected cash on your 74 shares, you would have got $80.66 in 10.3. You would have got $44.40 on 10.31. $90.28 on 11.29, $93.98 on 12.27, $53.28 on 123, and $42.92 on 220, which would have given you a total of $405.52 in cash that you would have collected. Your 74 shares, again, remember, 74 is what you started with, would have been worth $583.12. So combined, your cash plus your share value would have been worth $988.64. So you only lost $11. Not bad for that one.
Yeah, not really.
Considering
yeah,
it's worth a lot less than that now. But CRSH, you would have collected $75.64 on 10.3, which would have reinvested 6.21 shares. On 10.31, you would have collected $37.44 with 3.37 shares reinvested. On 11.29, you would have collected $32.90 with 4.31 shares reinvested. On 12.27 would have been $33.63 with 5.7 shares reinvested. On 123, it would have been $28.01 with 4.85 shares reinvested. And on 220, you would have collected $38.55 with 6.3 shares reinvested. Sorry, it's a lot of data up front before we get to the actual point.
It's worth it.
So on 311, you would have had 107.74 shares total with your reinvestment, and they would have been worth $886.70. And on 311, the share price of CRSH was $8.23 a share. If If you collected cash, your 77 shares would have got you 75.64 on 10/3. On 10/31, you would have got 34.65 on 29.26 on 11. Well, fucking A. So 1, 2, 3. So 29.26 on 11/29, 28.49 on 12/27, 22.33 on 1/23, and 29.26 on 2/20, which would give you a total of $219.63 in cash you would have collected. Your 77 shares of CRSH would have been worth $633.71. If you combined your 633 plus your 219 in cash, you would have had 853.34. So Tesla with reinvestment plus CRSH with reinvestment would have given you $1,741.92. Tesla without the drip, just collecting cash plus Crash collecting cash without the drip would have given you $1,841.98. Tesla was down about 5% the last 6 months. So here you have you have over $100 in difference just collecting the cash. So again, here it's when we're not reinvesting. If you do the pair, now obviously if you don't do the pair, you like the numbers are going to be different had you just went with say TSLY versus Crash. But the point of the Reddit thread was they were trying to do the long and the short because I'm apparently not the only one that has that theory where if you hold both, you're gonna like mitigate your price, your NAV decline. So the whole point of all this was to see what the difference is holding the pairs of those words, and it looks like in all three cases, if you held the pair of them, NVDY and DIPS, CONY and FIAT, and TSLY and Crash, you would have actually made more just reinvesting, just with getting cash instead of reinvesting. All three of them. So again, like obviously holding the underlying stock is probably a better strategy in all three of these cases. Except for I don't want to hold it on the underlying stock. We're more interested in income, and the people on Reddit, the reason that they're in YieldMax is because it generates a lot of income. So if you're one of those people that's on the fence about the YieldMax, you can mitigate the risk of holding them and the NAV decline by actually just taking your dividends in cash. I did this with these 6. I'm probably going to do it with a few more down the road whenever I have nothing better to talk about, or we're in the middle of a recession and no one cares, and I'll just rerun some numbers. But I'm fairly confident that actually just getting your dividend payment in cash is going to be at least 90% more effective in all the overall the YieldMaxes than reinvesting. What reinvesting does is because the NAV decline or the NAV price of all the YieldMaxes is so volatile, and it's generally volatile in a downward trajectory. When you reinvest, you're getting more shares,
but your price is declining.
But your price is declining every month, and then if you go to sell the shares to generate cash because you're not taking it in cash, you're selling your shares at a lower price. You have more shares, but you're selling them at a lower price, and that's not the way that you want to do it. So you'd actually have to hold the shares until it went back up to like around where you bought it, if that was what you were doing. If
it's even going to go back up.
Now, some of them are ran better, like I've mentioned AMZY and MSFO, but those ones you're not getting the 60, 70, 80, 90% dividend. You're only getting like a 20 to 30% dividend. I mean, only.
And they don't have a short side, do they?
Not yet, but I'm sure they will at some point. So like there are, within the YieldMax sphere, there are ones that are ran better where you're not losing as much in NAV decline. NVDY is one of them. Up until the last 7 weeks when it went down a lot. AMZY is another good one, and MSFO is a really good one. Now, there's newer ones that come out that have came out recently that don't have as much data, but they have like a less NAV decline. But if you look back at all the YieldMaxes when they first came out, the NAV decline was negligible. That's just like the nature of the beast. Like when it first comes out, people are excited, they pour into it, and it keeps the total amount under investment, the price up, and they don't have as much NAV decline. But if you give it some time, like PLTY is like a super popular one on Reddit and Facebook, where people are like PLTY is like, but I say give that one 6 months because like all the ones that we went over, or like TSLY has been around for like 18 or 19 months, NVDY has been around for like 2 years, CONY has been around for I think 2 years as well. The short ones are newer, but they've still been around like 9, 10, 11, 12 months. The newer ones, when they come out, like if you look through all the charts of every YieldMax, like when they first come out, they start at 20, and then they generally will go up, and they'll generally but they won't kind of deviate from the $20 range for a few months, and then they just whatever happens once they break through the $20 floor, they go down, and they go down pretty hard. But to generate income, you want to generate income. You don't want to reinvest.
Yeah.
And we've been saying that, I've been saying that for a while now, and people didn't know about it. So we went and discussed it with them, like on, they send us questions on YouTube, or they send us questions on Facebook, or wherever they send us questions. And like, I was like, dude, if you pull the data and you look at it, you make more money not reinvesting. The only time that I recommend reinvesting the shares is when you've pulled your initial investment out and you don't have a need for the money that you have in YieldMax. So say you have like, the reason you're using YieldMax is for like a car, buying a car or buying a house, or like in our case where we're going to go on the road. Once you pull the initial investment out, you can let it accumulate until you actually need the cash. And then you can then turn the drip off, and you'll actually have all those shares at the higher, you'll have a lot more shares. So you'll be getting a higher income per month. But in the beginning, the first thing that you should do with the YieldMax is literally get your money out.
But if you let it compound when the price is really, really high, an advanced strategy for this is what Tim always talks about. Like, he keeps an eye on, like, Amazon's a really good one. He knows the price band that thing hangs out in, and he'll turn it on when it's down, and then he'll turn the drip off once it goes up. So you're accumulating at the lower price, and you're not accumulating at the other one.
If you implement that strategy, there are some things $20 is the initial payment price.
It's the datum point.
But you have to monitor it, like, because like at some point that $20 floor is going to become $19 floor. Mm-hmm. It just is the nature of the nature of these beasts.
The NAV decline. Yep.
So then you have to adjust your price. Like, so if it falls below 19, you obviously will collect the drip, and then you'll turn the drip on. And then if it shoots up above 19, you'll turn the drip off. And then you'll have to adjust that as it steps down.
Now, how often do you adjust that? How fast does that fall?
Every quarter, probably every 3 months.
Is it every quarter? Okay. I was wondering if it was as fast as a month.
What I'm noticing, though, with a lot of these is once they drop too far, they'll actually do like Carmen said earlier, they'll do a reverse stock split where they'll like
TSLY.
If you have 100 shares, they'll give you 10 shares. So they're pulling 90, like whatever.
I think that was a 2-for-1. I might be wrong.
Whatever they pull off the market. That way, when they, like, if you remember, we went through this before, when they do a reverse stock split, what they're doing is they're taking shares off the market. So there's less shares that then naturally will shoot the price back up to the $20 range. TSLY has done that already. I do believe ULTY will probably do that at some point. That's one that we were in until recently.
We aren't sure if CONY's going to do that or not. It really depends if crypto turns around and that thing falls.
CONY could do that soon.
Which would be interesting, considering how much money we have in that.
Or they may not, because crypto is starting to turn around. Like,
fingers crossed, baby. Fingers crossed. I mean, even if not, it is what it is.
And I do believe, like, I haven't done the data yet, but I'm assuming that the YieldMax strategy can be applied to the weekly dividends, like the XDTE, the QDTE, the LFGY, all those ones that there's like 11 or 12 that pay weekly. I assume that you could do the same strategy with those weekly dividend pairs, where you just say you put $1,000 and you wait till you pull your $1,000 out in cash before you turn the drip on. We're currently doing that with
pretty much anything that has the covered call or the synthetic call is something you want to.
It's more the synthetic call than the covered call.
Well, it's more that, but it depends. But again, if you get your initial investment out first, the covered calls, they're more secure.
They actually have the shares of the stock, whereas the synthetic calls, they don't hold anything.
But some of them still do have a little bit of NAV decline, don't they?
They do, a little bit, but like FEPI is one that has covered calls, and that's been pretty solid. AIPI has had all the rec shares we win. They have the covered call,
okay,
and they've held up pretty well. What I'm finding, the synthetic calls of YieldMax is because they don't hold anything. They're very volatile, super volatile, and because they don't hold anything, there's nothing really there to stop the decline. Like, so when
which I really have a hard time understanding that, considering they have so much money in treasuries that they're holding.
They use the treasuries as collateral.
I still don't understand how that's not.
So if they have,
that doesn't actually have any value.
So they have $5 million in treasuries. They can write $5 million in options, and if the options go to shit, they have money as collateral to pay for that. It's like if you have a margin account, say you have $10,000 in margin from your portfolio, you should have $10,000 in something else that you can liquidate real quick to pay off the margin call. And that's kind of what they're doing with the treasuries.
And I imagine if it hits that means it's kaput. So they just do the reverse stock splits.
They will do at that point
until they can't
do reverse stock splits anymore. To me, because we identified pretty quickly how to not lose money in YieldMax, they're pretty reliable payers, and they're no more risky than, say, the ETNs that we've brought up or the other high dividend stocks.
If you listen to last week's episode, the ETN, USOY, USOY, That thing, that's actually our highest payer for our dividends each month.
They have USOIs, the ETN, they have SLVOs, the ETN, and they have GLTIs, another ETN.
But we got out of the other two.
What the ETN is, if you don't know, is that's an exchange traded note. So they just have a note that they have X amount of for USOI, they have X amount of USO shares. Because the USOI is based on the USO, so they write options on the USO stock. So they have the exchange traded note means they actually don't hold anything. Again,
so it's like YieldMax,
it's just
kind
paper.
of.
Yeah, it's just paper. So like any of those things that hold nothing, like synthetic calls, to me, I might be wrong. If you guys want to yell at me, like people have been doing recently.
Getting so much heat. It's so funny.
To me, synthetic holding is you don't have anything. You're just holding options on the long. You're holding options on the short.
I think they're worse than crypto, actually. Like, they're really nothing compared to crypto. Crypto actually has, like,
and
tech.
ETNs, to me, like USOI, SLVO, GLDI, again, to me, they don't hold anything other than paper saying that they have options on these underlying
Whoop-de-doo, Basil.
So those, to me, are more risky than, like, a 14% BDC. Mm. But if you implement the right strategy where like your whole objective is to get your money out as soon as possible, that way it doesn't harm you. Like if they go to zero or they call everything back, it doesn't matter because you already got your $1,000 or you already got your $2,000 out of.
Yeah. So the strategy for YieldMax is essentially if you are brand new to investing, the best way to keep momentum in the beginning is to have results. And so if you take like $500, you put it in, you get results. You can then funnel that money into better stocks to then start building your good portfolio out. So these can work as something like that. Or if you get that initial cash back out, then you kind of just let the shares just pay and pay and pay and pay and pay. And it just kind of becomes a paycheck while you're growing the rest of your other stuff or letting that compound. That's what we're planning to do when we actually like get the money from the condo proceeds. We're going to dump a good chunk into the YieldMax. We're going to use that as our cash fund so that our actual portfolio can continue to compound and grow so that whenever YieldMax goes like shits the bed, completely disappears, if they do, then we have all that time of compounding to then have that nest egg growing or that dividend growing.
I ran the numbers, and I know I brought this up in a previous podcast, but with like $40,000 in these things that are riskier, we can actually generate like $3,000 a month in cash. Mm-hmm.
To me, that's worth it.
If you extrapolate that out, that's like 15 months of cash payments to get your initial investment out.
Then you have
$40,000 in payments coming in for as long as they come in that you don't have any like skin in the game, really.
How much money did you say? 40,000?
40,000. So
if you took that 40,000 and you divided it by that $3,000 a month, say you're spending that, you'd be living for 13 months. So if the YieldMaxes pay out that $3,000 for more than 13 months, as opposed to you spending it on your normal expenditures, you're actually like ahead. And that's how we're looking at it.
And what I'm seeing what a lot of people do that I don't agree with, even if they employ the same strategy that I use, is they are actually using their brokerage and they're doing these on margin.
Ooh. They're already kind of like a margin.
If you're not familiar with margin, what margin is, like if you have, say, $100,000 in your brokerage account, you can borrow up to like, I don't know what it is, $80,000 on margin.
And since Robinhood allows you to do that, like collateral exchange.
What margin is, it's like a second mortgage, basically. In my view,
I think you'd be better off with an actual second mortgage than doing the
because margin is if they call, like say you have less, like they do a margin call, which means that your shit went down a lot.
Yeah, so if your value of your stocks go down below that margin, they force you to liquidate other aspects of your portfolio to cover that. Or depending on the way you have your brokerage set up, they might actually completely liquidate your position to make up that difference because they will not let you go below that threshold because it puts the brokerage at too much risk. I've lost like $40,000 doing that.
So I don't agree. I do not agree with that strategy, putting these YieldMax on a margin.
Yeah.
Now, if you were going to do a margin, I would say, okay, I want to put $40,000 in the YieldMax. If I was going to do margin, I would do something way more reliable like MO or IIPR or something like that, where you're getting 7, 8, 9, 10%. But you're not at risk for a serious. But at the same time, if we right now are on the cusp of a recession, if not potentially a bigger recession, I don't think this is a good time to get in a margin period. Because you don't know. Personally, I don't do anything on margin.
Yeah, like that is very risky.
Because I don't want to actually be forced to liquidate my positions. Mm-hmm. And my positions are generating cash. You saw we did with the last 2 podcasts where how much we're making off the positions. I like what we're making. I don't want to have to liquidate. I don't want to be forced to liquidate anything that'll like lower my monthly income.
And I don't know if margins work the same way in brokerages as they do in crypto, because that's what happened to me. But it was like a daily charge that you got for the margin that you had out while the stock was in play, or
they do. I think it's monthly. Like they do a monthly loan.
It was daily when I did the crypto thing. But so here's the deal: when we did this CONY experiment with the YieldMax, I took a loan out to take that 15 grand to put it in. So it's like a 17% yield. I don't know what the actual cost of margin is, but I actually think that's more secure, like from a cost perspective. Plus you don't have to force to liquidate jack squat. And as of right now, the CONY payouts are actually making whatever the payout would be on the loan to begin with for minimum payment. So
no, we did go over that. I
think that's less risky.
As long as the CONY dividend stays above 29 cents, we'll be able to make our minimum payments.
It was 26.
Oh, 26 cents.
26. And that's
we'll be able to make
not
that's just the bare minimum payment.
That's the minimum
26
payment.
Cents.
But as of right now, we've been paying back the whatever the heck we get extra on top of that. So we have, I think, like 18% of the loan paid back already in the first 3 or 4 months. 4 months, I think we're at.
We're due for another disappointment here in a week.
Oh my God. Has it gone up at all? Has CONY gone up?
It's at like 8 something.
Well, was it like 7 something?
It's at 8 something now.
I think it was 7.94.
I don't know what the next
I do kind of hope crypto like pivots, because
it showed that
Coinbase is based on like Bitcoin, and Bitcoin, like whatever that does is what affects CONY.
So like for what I'm saying is like, so if you guys watch this, you have any questions, just leave a question in the comments. We go through the comments pretty regularly, daily, if not hourly. She's crazy about that. I will gladly walk you through anything. And there's been a couple videos that we've actually recorded because we didn't feel like typing, that we've posted. Where did we post those? TikTok. So
and
we did
YouTube.
A couple TikTok and YouTube videos where it's like, this is too long to type out, so I'm just going to talk to you. Mm-hmm. But like, if you have any questions about anything, like anything that we hold or anything that you think
we just did missing, literally a stock that we don't even do. We just did a review or what Tim thinks about XDTE.
QDTE, which is the round hill. They're the 0-day options. They literally will write an option at night, and then they'll let it go to the following day, and then the option's over at the end of that day, and then they just collect the premiums from that, and they just accumulate that, and they put that into treasuries, and they give you a payment at the end of the month.
Yeah, they're pretty similar to the
They're nice. Like they're good cash generators. Like it's 30%, but it's a lot like FEPI and AIPI. You're getting 30 or 40%.
But the point was just that, like, if you have a question on something we haven't even talked about, like Tim will totally evaluate it and let you know what he thinks. So I mean, any question, whatever.
Except for O. I'm not talking about O anymore.
Oh man, we got some heat on O.
Because apparently people are really touchy about O.
I really got hard-ons for that when we said that we thought it was gonna.
The next podcast is gonna be like how I evaluate REITs, because there's some
apparently people who are crazy pants is about how
some
that's
problems
evaluated.
with how I'm evaluating REITs. So I'm gonna go through exactly how I evaluate them. It's like they think I just literally look at the profit margin, which is not the case. Yeah. But
oh man, we got some heat on that. That was
there's
fun.
Some people who are really pissed off about that.
You shouldn't be. Don't stop making videos because you don't know what the hell you're talking about. It's like, then stop watching the video.
Yeah, it was really really negative emails or comments, and it's like whatever. But like now I'm gonna make a podcast and an email about how I evaluate REITs, and there's like 8 or 9 factors, not profit. The profit margin is like one of the.
And now I'm actually really curious to see what actually happens with O, because they don't think that it's going anywhere. And Tim's like spidey sense over here. I hate to say it, but like the experience I've had with him for the last 3 years, usually when he has a spidey hunch, things happen. And that's I don't know if we talked about PTMN on here. I think that was also another reel. But PTMN, it's a BDC, right? So Tim's looking at it. The BDCs kind of tend to move in a pack. And Tim basically was like, what the hell is going on with PTMN? We were only in it for like, what'd you say? A couple weeks? 2 months? 2 months,
if that.
And he's just like, something's wrong with this. He's like, something's just wrong. He's like, I can't see it in the financials. I can't see it in this, can't see it in that. So he sells it. And then the earnings report comes out.
And they cut their dividend by like 30 some cents. So like.
And it had a like, how much was that cut? It was like a 50% cut or something?
It was like 50%, yeah.
And then it had a 24% like actual price drop. So we like completely avoided another Icon, MPW, and like Camping World. So like, dude, high five. That's like all I gotta say.
But what I've said about O is I don't think they can sustain the dividend.
Yeah, even if you're not supposed to be using the...
They're like, well, you have to look at the AFFO, which is the adjusted something...
Financial.
Free cash, whatever. from operations.
Yeah.
Which is fine and dandy. But if you look at all the other metrics, their debt's gone up, their revenue's gone down. They've actually taken on more, like they used to be like a pretty specific REIT. And now they're kind of branching out into different components of real estate. And like, I don't like all their, like, it's very difficult to maintain revenue and costs whenever you have your hands in 16 different components of REITs.
Their debt's gone up. Their payout ratios like 300 some percent. I think it's 311%. And then there's like a whole assortment of other factors. Tim said that some of the
I get that they've raised a dividend like 30 some years in a row. I'm not disputing that. Like,
but that's pressure to keep that raised, right? Keep borrowing.
You see their debt going up. They're borrowing more money to pay on their dividend while they're investing in other stuff. So like something's going to have to give there at some point.
Yeah, something's got to give somewhere, and
they're going to have to refinance that debt because they've taken on debt the last like 4 years since COVID. They've taken on a lot more debt. So they have to refinance that debt at some point.
So unless they drop the interest rates and it actually makes sense to do that.
If the interest rates go down, they might be lucky. But if the interest rates don't go down, which I don't think they're going down very much, they're going to have to refinance the debt at a higher interest rate with all the debt they already possess with less with less revenue. Like they have like a lower EPS. I don't know. Like there's just something about it that I don't like. For me, REITs are a risk reward. So what am I willing to risk to get a yield? In O's case, the yield's like 5.5%. So what am I willing to risk for a 5.5% yield? It's not what they have going on. Not with those metrics.
Nope.
Not what they have going on. I would rather invest in ABR, which has way shittier metrics in some areas than O, but you're getting a 14% reward for that risk. Mm-hmm. But that's my opinion.
Yeah. And again, we didn't say you didn't have to invest in it or you had to get out of it. And these people were just like chomping. It was really funny. So, it was really funny.
Sorry for the tangent. Next week's email is going to be how I evaluate REITs. So like this is a segue into it.
I'm actually really curious. So that'll be fun because we've done, I think, stocks in general, and we've done closed-ended funds?
Yeah, closed-ended funds.
Is it closed-ended funds? Yeah, I guess it was closed-ended funds with the NAV and everything.
I'd rather actually hold a closed-ended fund that deals with REITs that has O in it. But that's me.
Facts.
So we'll see you next week. Have a good one. Next week's REITs.
REITs.